banks, because these funds, they're getting priced directly from the central banks. You're not getting priced directly from central banks. You're getting priced from a broker, who's a third party entity getting priced from a liquidity provider. And that's why if you look at brokers and compare them to each other, the open high, low, and close of the high and low of candlesticks usually will vary. Usually open and close will be relatively the same, because that's where I have the bulk of volume in a specific candle. Alright, so as prices declines lower, the commercials will buy to provide sell-side liquidity. So they act as counterparty liquidity to the funds. And this is how you get the provision of sell side. As price declines, commercials buy from the funds. Alright, so commercials in this example, they are at central banks. Okay, so this is what we call market maker hedging program. It is a hedging program. Liquidity is provided in the marketplace by a hedging program from the central banks. Alright, so as price declines, they will accumulate or buy. As price drops down even more, they will stack on and buy more, which facilitates delivery of sell side. As price drops lower, they buy even more. But now remember, every single time price declines and they're buying, their baseline position is increasing, so they are getting increasingly net long. Okay, so they do it gradually, which is what I teach you with price ranges. They come into the marketplace, they'll do it gradually. They'll buy a little bit, and then the market declines, or allow the market to decline. Then they'll buy a little bit more, and then the market declines. Then they'll buy a little bit more. Then when the market gets into extreme discount, higher time from discount, and they are buying, finally, this is where they're extremely net long. So their books is now extreme net long. Once their books are now extreme net long, order flow shifts to the buy side. Now they have to start providing buy side liquidity to the funds. So what do? As the market starts to rally higher, they mitigate against pre-existing longs. So they sell the pre-existing longs to mitigate position. Right? So as the market goes higher, remember, the funds are trend following. So the funds want to buy. When the market was declining, the funds were shorting, and the central banks were buying from them. As the market rises higher, the funds would then sell against, the central banks would then sell against the funds who are buying. This is how liquidity is provided, and in the process, they also will mitigate pre-existing positions that was used to facilitate order flow. Remember, the number one job of the central banks is to provide liquidity, and then the number two job for them is profit, obviously. So this is your function. What I'm describing, this diagram describes the function of the central banks to price. That's why they are the ones who creates the market. They are the ones who set prices. They are the ones who know where price is going to turn, where price is going to reverse. They know all these things. So when they're net longing their books, the market starts to shift to the buy side delivery. Then they'll start to mitigate at old accumulation blocks. Right? So what are the accumulation blocks? Bearish order blocks. Why? Institutions will sell in up candle, and that's how you get order blocks. Now this takes us into the definition of what an order block is. Let's go out and then use a daily time frame and define what an order block is. So using the idea I just shared with the standard accumulation phase from the commercials. Now obviously if it's distribution phase, you just invert the diagram and it will make sense. So on the left you have distribution block, and then on the right you're going to have accumulation block. Due to the nature of the size of contracts and volume with these entities and these funds, they cannot sell when the market is declining. They don't sell when the market is dropping due to the volume of their transactions. They have to sell when the market is rising. Okay? Why? So as the market is rallying higher, they will short that. They'll short the rally. This is how the institutions get into a position. This is how they build up a position. So as the market is rallying, once the market gets on higher time from premium, in this example we're looking for sells, they will short the rally into that. And then the outcome is going to be the algo declining, price is lower. And declining price is lower. Okay? Now, a lot of times you're not just going to short that last of candle and just leave it at that, right? And you remember, they have huge contract sizes, so they have to build in orders, and that's why they're going to build orders around the high time frame levels, not lower time frame levels, high time frame levels, right? So they would have to return back, or the algo will return back to what we call the liquidity base. Again, going back into the first example where we have the range prior to expansion, that's called liquidity base. So the algo will return back up into that candle to allow for redistribution. Again, because we're short. Why? Because this candle here was where they previously sold short. If they want to sell short again, they have to wait for the algo to return back into liquidity base, and then they can build in more positions. Remember the elephant in the room analogy, which I use a lot of times. Elephant is walking into a pool in your backyard, and the pool is almost full, and the elephant puts its first foot in the pool, and the water rises a little bit, almost overflowing. And then the elephant puts its second foot in the pool, and then the water rises even more, about to overflow. And then the elephant puts its hind leg in the pool, and then the water starts to overflow. By the time the elephant is completely submerged in the pool, there will be an overflowing of water from the pool, and you're going to see lots of water being wasted. That is the same thing here with the way the institutions get into a move. They have to build in orders, and that's how you get order blocks, right? Order blocks which form around high time frame levels of premium. Okay, those are your high probability order blocks. Why? Because those are order blocks which have institutional support behind them. So once you see an up candle inside an high time frame premium, and then you see displacement, which is the follow through, that is your clue of the footprint of institutional money or smart money right there. And this creates your order block. So an order block is the last bullish candle prior to a decline. This is for a bearish order block, and obviously for a bullish order block you just invert that. So that's the last down candle prior to run higher. That's a bullish order block. So what you're looking for, you're not shorting the same way just like the institutions up here. Okay, that is way advanced for you right now. What you're shorting is the return back into that order block where they're going to build in more positions. That is where you are going to frame your trading idea. So now let's look at some live price examples there, and we're using bearishness. So we have a short term high up here. Market runs above the short term high. What do you think is going on right there? We are engineering liquidity on the sell side. Why? There's going to be a lot of individuals wanting to go long at the breakout, and that creates a pulling of sell side liquidity below all the short term lows here and the short term low here, and ultimately the parent price swing down here. So as we ran above that, what's going on there? They're selling. What is the evidence that the institutions were selling the rally? This displacement lower. Now if you miss the chance to sell here, which obviously you're not supposed to be doing so because you don't know if it's going to blow through or sell short. If you miss the chance to sell there, you have your bearish order block right there. So what happens? The market goes back up there to redistribute or to build in more of the pre-existing positions up here, and then delivers to sell side, and then delivers to sell side. That's how you get a bearish order block. And then for a bullish order block, just basically the same thing. So if you look for delivery higher, right there, this is the last order block prior to the expansion higher. So if we take out the range, that's an area of sensitivity. Why? We're coming off of an higher time frame level. Again, this is a daily level, right? Candle here, market trades down into the 50% of that candle there, sees expansion, trades back down into 50% of the candle, sees expansion. This is a liquidity base. This is where institutions would have built-in orders in the marketplace. I'm trying not to make this video long, so I have to make sure in the next couple minutes I finish the video so it's not too long. Alright, so we're back. Here we have a run on buy stop. Market displaces lower after the run on buy stop, and we have a retracement up into bearish order block. You can see trade up there, and then the market runs into discount, small little fair value gap here. If you don't know where fair value gap is, I will do that on a subsequent video, so don't worry. All right. Then returns back up there to reclaim. So now let's talk about reclaimed order blocks. A reclaimed order block simply is an order block that has been utilized more than once. Now when we're using the reference point, typically we like to see sensitivity immediately the market trades into it. Alright, so if we're using an order block, the first time the market trades up into it, we want to see sensitivity immediately. But if it goes up into it a second time, that is allowed, and we call that reclaimed. So they're reclaiming a level to build in more positions. That's the idea right there. So this is where you get the idea of a reclaimed order block, and obviously you can talk about reclaimed breaker blocks, reclaimed mitigation blocks, reclaimed fair value gaps, reclaimed rejection block. The only thing we don't have is a reclaimed old high or low. Alright, but all the other essential reference points, they can be reclaimed. Now let's talk about what a mitigation block is. A mitigation block simply is a failed order block. That is what a mitigation block is. So what do I mean? If we are assuming let's see, if we're assuming institution sold short inside this up candle and we see confirmation with displacement lower, the logical anticipation would be, if our daily bias is correct and the market trading up into the bearish order block, it has to offer sells. Right? That is the logic behind this. So the market trades up there, it has to sell short. Now what happens if the market trades through? So I'll give you an example. So the market trades below the last up candle, that is the wick of that candle, and the wick up here, and then you set your order block for a short, and then the next candle opens up and trades like this and closes above the order block. So we can make this, well, let's do like that. Okay, it's fine. What happens to this order block? Well, this trade through the order block on a closing basis above the body. Again, I'm not interested in the wicks, I'm interested in the body of the candle. This trade through above the body of this last up candle prior to run lower indicates that this is not utilized for shorts. Remember, in up candles around key levels, when you see displacement away from there, use that candle for in the future to sell short if it's at premium. Now obviously if it's at discount, use that to go long. If the market trades through like this, it invalidates this as a level for distribution, and this now becomes inverted as a level for accumulation, and that makes this a mitigation block. So mitigation blocks are simply failed order blocks. Okay, that's what mitigation blocks are. Think about the word mitigation blocks. Mitigate. Right? What are you doing? Mitigation simply means you got something wrong. You're looking to recoup. That's what mitigation means. That's what's going on right here. So market trades through, invalidates this as an area to short because it's no longer valid, since if it was supposed to be valid, it should show a willingness to want to respect this candle as an area for sells, but it's not. So this is not valid for shorts, and then you invert this and it becomes an area to go long. Mitigation block. Going back into this standard commercial accumulation phase, that is literally what's going on here. When the market starts to trade above, it starts to trade through the bearish order blocks, and then they become mitigation blocks. So if you watched the video I did on cable last week, where I described what cable should be doing before it actually happened, and I said this is what cable should do and this is what cable should do, and cable did exactly that. Alright, this I told you beforehand. If you go and watch the commentary, the evening commentary before all of this happened, I said watch this level for a sell off. Why? This is a mitigation block. Why is it a mitigation block? Well, if our assumption is we're bullish, obviously our assumption was bearish and wanted to see the market trade through. If our assumption was we're bullish and we're using this as a bullish order block, guess what? It fails. This mitigation block fails. The moment you see the market trade through in the closing basis through the body of that mitigation block, it becomes an inversion level. So it becomes an area for distribution. So this is a lower time frame market maker model. See? So this is going to be a market maker or a commercial distribution phase, not a commercial accumulation phase. We're going from shorts to longs. In this example, we're going from longs to short. So you can see we have a range here, then we have another range here, and that is going to be a distribution block. Sorry, an accumulation block. Just like we have, my bad, that's going to be a distribution block. Why is it going to be a distribution block? Because as the market rallies, they sell into the rally. They'll sell into the rally. So in this down candle here, and I'm explaining the concept behind an order block. Inside this down candle here, commercials will sell and institutions will buy. And that the algo will price the market higher, gunning for an high time frame premium and above where there is pre-existing liquidity. Right? So this down candle here, commercials will provide liquidity by selling into the rally, and the funds or the large speculators, they will buy the trend. Again, you're trend following, so you're buying the trend, and the market expands higher. And we have a little bit of a consolidation here, what I call liquidity base. Order comes into the marketplace. Guess what the market does? Expands higher. Down candle here, commercials sell into this again, until the market rallies, and then the funds are buying here. Now this is the caveat to this. The funds, they take lots of losses at market turning points because you're trend following, and this is where the market makers or the central banks, they'll book profits against the funds at turning points like this, because funds will see stuff like this, they're buying the breakout, while the commercials or the central banks, they're now extreme net short. Because remember, as the market was rallying, they were selling into every rally. They were selling into the rally. And then once the market declines and revisits an area of fair valuation and starts to decline, they will then mitigate. This is an old area of distribution. They will mitigate that position there. So they will buy back their short positions. You're buying it back. The market trades lower, and then they're buying back. Do you think this is random that the market is trading back into the open of this order block? Look at this. The open of the order block here of this candle is 1.21059. The high of this candle is 1.21061. So this is off by just 2 pipettes. You think it's random that this is the level of precision that this can turn up into? Of course not, because if you're using this as an order block, you'll be using the body of the candle. Why? Because this candle already traded out into the high of this candle. So if we're going to use this again, and this is something you want to add to your notes, whenever we utilize this most sensitive portion of a bullish order block is the high or the wick of the candle to the 50% of the body of the candle. But usually you want to see the high of the candle and the open of the candle for a bullish order block. For a bearish order block, you want to see the low of the candle and then the open of the candle. For a bullish order block, high and open. Bearish order block, low and open. And then if it trades through the opening price, then you watch for 50% of the body. So that means you take the range of the candlestick body. Why are we using the body? Why are we not using the wicks? That's the question. Reason why is because wicks are going to vary between brokers, but body is going to remain the same. And body is where transaction, the bulk of the volume of transaction is done. That's why we use the body. So you take the body, measure 50% of the range, outlining there, and for that order block to be valid, price was not closed above 50% of the body of an order block. The moment price closes above 50% of the body of an order block, automatically it invalidates that level as an order block, and then you can wait for price to trade through, then use it as an inversion level for longs if initially you're trying to go short. Okay, and same thing with a bullish order block. The sensitive portion is the high to the open, then you can allow for the 50% of the body of the bullish order block, and we call that mean threshold. So I'm going to type it out so you understand the term. We call this mean threshold. Okay, that is the 50% of the body of a bullish or bearish order block. Now, because in this example we're looking at this being reclaimed. Why? Because we've traded down here before. If this was to be reclaimed, it should bounce away from the body, but it did not. It traded through. Automatically, it invalidates this as a bullish order block, and it becomes an inversion level, and like that, it's a bearish order block. Remember, go and watch the video I did. I told you exactly what was going to happen and where it should happen before it actually happened. I think it was the video I did on 14th of February. So go and watch the evening commentary from 14th of February, where I was doing my analysis on cable, and I described literally this, everything all the way down to this from lower, and that understanding stemmed from the understanding of this. So that is order block and that is mitigation block. On the next lesson, we're going to talk more on highs and lows and liquidity pools and open float and all of those different things. That's going to be the next video, and then from that we're going to go into lesson 2. So hopefully this has been insightful, and I hope you enjoyed this. I'll catch you guys all on the next lesson. Be safe.